Dividend investors, bonjour, this is Mike Yeru, founder of Dividend Stocks and passionate investor. So earlier this week, I told you I would discuss VF Corporation. If you're looking for a company with a strong dividend growth profile and a company that got beaten down during the latest market drop and hasn't quite recovered yet, well, this company is for you. Right now we are on Dividend Stocks website. The stock card has just been updated a couple of days ago, and we're going to go through it, see what DSR has found about VF Corporation. So first, what you can see is we obviously have a pro rating of 4 and a dividend safety of 4. So this means it's a buy and you can expect more dividend growth in the futures. Actually, the company has grown its dividends since 1973. So if you're thinking, well, I don't know about the apparel industry, I don't know about clothing, I'm not seeing this to be thriving business. Wait a second, there are lots of growth vector for VF Corporation. The company has been around for more than 100 years and 45 years of consecutive dividend growth. It's hard to beat, right? Now, it is a great opportunity to seize it at a 3.5% yield, which is pretty cool. So let's take a look at what they do. Basically, their business model is they manage branded apparel and accessories. So we're talking about roughly 20 brands. They have Vans, North Face, Timberland, Dickies. So basically, strong brand, strong portfolio here. The company has been around since 1899, so it's pretty much cool. And funny fact, they started as manufacturing mittens. So how they went from mittens to going for Vans wear, the thing is, they're brand managers. It's not only about making clothes, it's actually a company that is looking for undervalued brands. They buy it, make it better, make a good marketing, and sometimes they keep it like Vans or the North Face, and some other times what they do is they just get rid of it, sell it at a nice profit, or making a spin-off, which is actually what they did not too long ago with their jeans brand, and they spin it up into Contour. So what happens here is the company is constantly renewing their brand portfolio. They're always looking for more better opportunities. So it's not like an old apparel company that is just trying to sell their t-shirts and shirts. They are managing brands. On top of that, they have a strong digital channels. They're pushing a lot on direct-to-consumer sales. Obviously, it is making a lot of sense right now. The reason why the company has been hurt recently is because they're still in a lot of malls and a lot of retailers. We all know it's a rough time. However, while a lot of companies, especially in companies that are in the retail industry, are cutting down their dividend or announcing suspensions, they confirmed their dividend a couple of days ago as well. So they have no intention of cutting it right now. They are sitting on a lot of cash, and they are able to, they're selling for 12 billions of sales each year. It's huge, right? It's a lot of t-shirts. Now let's take a look at the dividend triangle, which in this case is quite strange. So usually what I look at a company, I like to find a company with revenue growth, telling me that the company has growth vector and a leader in their market, earnings growth telling me that they have nice margin and they're not only selling their stock for nothing, they're actually selling their stock and making more profit, and ultimately dividend growth. The thing is, when you have a company like this that is doing spin-offs and stuff like that, it messes up all the information. So what you see here is a revenue drop because they spun off their jeans like Wrangler into Contour. Same thing with the earnings, but in reality, revenue and earnings has been increasing on a steady basis. What you see here is not a dividend cut, it's just a dividend readjustment, as I just mentioned. So the company has grown its dividend for the past 45 years. It's not going to stop anytime soon. I'm pretty sure they're going to be part of the famous dividend kings, which are companies that has increased their dividend for 50 years. They're just only 5 years away, right? Now, in terms of potential risk, what you're going to see is obviously when you buy and sell brands, there's always risk in the mergers and acquisition of that. And the biggest risk right now is the COVID-19 impact on the economy. At this time of recording, we're on May 21st. Happy birthday, dearly. It's my wife's birthday, by the way. So I'm doing this quick video and then I'm setting the time with her. Back to VF Corporation. What's happening here is obviously we have lots of good news in terms of economy reopening in many countries. The virus seems to get slightly under control, and I'm just, I'm not saying it's done. I'm not saying it's under control completely. And a second wave could happen, and if this happens, it's going to be a very bad thing for retailers, and VF Corporation is going to also get a hit on this one. So obviously, as I finish the potential risk analysis, I noted that shareholders must remain patient. Just make sure that you buy this one, you put it in a black box and forget about it for 5 years, and then when you reopen it, you're going to be very happy. So as I mentioned earlier, they have cash flow abilities. Their current ratio is at 1.66, so they have some money on the side. And interesting here, you have like high payout ratio and high cash payout ratio, but this is, once again, you have to dig a little bit further. The problem right now is that there's been only 1 year with the spinoff, and you have to pretty much go back into the financial quarterly earnings. Take a look a little bit deeper, but the dividend is safe. They just reconfirmed it, and it's basically not the right payout ratio that you see here. It's just more accounting problems. I'm not a big fan of valuation methodologies. However, if I use the dividend discount model, using a 6% rate and a 9% discount rate, what we have is an intrinsic value of $67.84. This gives you a good margin of safety. It tells you that there's probably room for growth. I think that the most interesting part about VF Corporation, it's its growth potential, not next year, but pretty much in the next 5, 10, 15 years. Because think about it, right now, retailers and brands are having problems, right? The economy is on lockdown, and a lot of smaller players or players that had difficulties before are not gonna likely do a better job in the upcoming months, and those might go bankrupt, they might fail, and their assets are going to be on sale. What VF Corporation do best, you got it, they buy brands. So imagine like all the brands in trouble looking for a buyer or just simply going bankrupt, and then VF Corporation can just pass by and simply grab those assets at a very cheap price, remodel them, do a strong marketing, and when the economy reopens and everything is fine, probably in 2022, then they're going to be thriving because people are going to look to buy more clothes, look better, seek for entertainment. We have seen that after the Spanish flu. I'm expecting at one point in time, people are going to go out and want to feel better about this pandemic. It's not going to happen this year, that's for sure, but it's a long-term play. Disclaimer, I do have VF Corporation in my portfolio as well. I bought some shares during the crisis, actually, and I think that right now it's still the moment because it hasn't recovered too much compared to other companies. The market is waiting to see how long the COVID-19 will impact the economy. This is unknown. Please do your own due diligence, and this is not a buy and sell recommendation, right? But I mean, I would just put it on my list and try to dig up a little bit more. So I hope that you have enjoyed this video. Don't forget to subscribe, or I can't make it anyway. Subscribe to my YouTube channel. It's been fun times with you guys, and next week I'm going to come back with more videos. So until then, stay invested.